One very interesting thing that happened, that the U.S. tax court came out with a decision on the case of R.V. Paschall versus the commissioner. Paschall's. This is Tax Court Memo 2024-26. Paschall was staking Cardano, and he took the position that the staking rewards would be taxed when they were sold for dollars, not when he received them. This is how his audit went down. The auditor disagreed. He took it to tax court. He actually went to tax court and represented himself against 5 IRS lawyers. And he made his own case for that. And the judge decided against him. Now, 85% of US tax court cases are petitioned by the taxpayer themselves, or what lawyers call pro se in Latin. And that's very common. Now, I'm going to dig into this in a second, but a couple comments. First of all, this is a memorandum decision, which means it's just a decision from the one judge, and it's not binding on all judges in the U.S. tax court. There's I think about 13 judges in the U.S. tax court. So on more important decisions, all the court deliberates together. But this was just an individual decision. It's non-binding. It's just this judge's opinion. This opinion reinforces IRS Revenue Ruling 2023-14, where they said that income occurs when a taxpayer gains dominion and control over the validation rewards and would be at fair market value at that time. This guy's case, Paschall, he had $25,000 of taxable gain that the auditors accused him of. Plus, there was about a $5,000 penalty on top of that. So that's what the stakes were. I looked at the arguments, and I felt that the taxpayer made a strategic error in making an agreement with the IRS during the negotiation process of the court case that the rewards became the taxpayers when they were awarded. So he acknowledged that he had dominion and control over them at the time that they were awarded. However, I believe this is a fundamental mistake. And this is why it's good that this is just a memorandum decision, because particularly with Cardano, and it's true with all the other coins, these coins that you give to the validator cannot be sold until they're taken out of validation status. Those are the ones that you're staking. Secondly, the rewards that you receive from the validator keep going and accumulate. However, the moment you take your staking rewards out, that's frequently, not all validators, but definitely with Cardano, you receive your staking rewards only when you withdraw from the validator altogether. And of course, it's going to take a couple periods of being away from the validator, validation periods before they're fully received. But the issue is when you take your money out of validation, you actually stop receiving validation rewards. You're going to miss a period of time. In Cardano, that's called an epoch, and it's, I believe, 5 days long. So if you're awarded every 5 days for having been with a validator for 5 days. Now, once you take your staking rewards out, you no longer can participate. This would speak to the legal issue of constructive receipt under the U.S. tax code. And the judge in this case acknowledged and actually gave a nod to this issue that the tokens are income to the taxpayer when they're constructively received. But the taxpayer never raised this issue. In my opinion, in the case of a Cardano situation, they are not constructively received until you leave the validator and actually receive them. You can't get them any other way unless you return it. Now, when you take your coins out of the validator, that is a significant financial disruptive event. You no longer get validation rewards for a couple epochs until you can reinvest. So that is a significant implication in my mind. So, that would be the position I would argue if I were to take this forward to tax court or to appeals. But I think this is a very interesting case. Another subtle distinction that came out of this case is the distinction between rewards that are directly received and rewards that are given to a custodian. In the case of Cardano, the taxpayer stakes his tokens to a validator. The validator kind of serves as kind of like a custodian, although ownership isn't transferred. But the custodian, the validator, is the one that receives the reward tokens, and then he gives it to the taxpayer later. A popular argument has been that these are self-created property. The argument, of course, we've heard before is like a baker, when he makes a cake, isn't taxed when it comes out of the oven, but when it's sold. Same thing with a car manufacturer. It's not taxed until it's sold. These are self-created assets, not custodial assets. And the judge disagreed with Paschall, the taxpayer, and said that these are not self-created tokens. The validator, they're the ones that receive the tokens from the process. It was not Paschall himself. So that was an interesting distinction that the judge brought out. Again, this entire case is non-binding on other tax courts' decisions, but this is probably the first time we've seen a staking case get decided at tax court. So very interesting development on that.